So you can have subsidized housing that subsidizes any housing within that spectrum, from very low income housing to all the way through workforce housing or middle income housing. And you can have naturally occurring affordable housing, where just because of the nature of the market, the value of the land, the location, even without a rent restriction or without restrictions through some sort of regulatory regime, you're ending up with affordable rates of rental streams, just because those are available and affordable to people at those lower income streams, at those percentages of AMI. So affordable housing kind of encompasses all of those things. The capital A affordable typically refers to those that are actually regulated, and then the sort of lowercase affordable includes naturally occurring and sort of unregulated affordable housing as well, that's still available to and affordable to, people with incomes that are below those AMI levels.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Danielle Ash. Danielle Ash is a partner in the real estate group and co-chair of the ground leases practice, as well as the impact practice at Adler Stachenfeld, a law firm based in New York that is solely focused on real estate. And in just a minute, we're going to speak with Danielle Ash about demystifying the reality of affordable housing returns and risk profiles. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how attractive our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Danielle Ash. Welcome to CREPN Radio.
Thank you so much for having me.
Well, I'm delighted that you're here and looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I'm a partner at Adler and Stachenfeld. We are a boutique real estate law firm based in New York City. We do deals all over the country and all over the capital stack. We've been around for a little over 28 years, and everyone in the firm focuses on real estate. We are what we call a pure play in real estate. So we have litigators, we have tax professionals, we have bankruptcy professionals, but all of them focus on real estate matters and real estate related clients. And we've been doing that. And in addition to focusing on the real estate transactional work and all the stuff that goes around it on the legal side, we also like to help our clients grow their businesses, which makes us a bit unique in the law firm space. So we actually have dedicated staff members and spend a tremendous amount of time actually connecting potential strategic partnerships, capital partners, people who need a new position, and we help our clients figure out sort of how they're going to increase the, value of their strategy, find the right partners, and make their deals be as successful as possible.
Awesome. Oops, can you hear me?
Mm-hmm.
Okay, I lost my video or my audio there. Okay, got it back. Well, that's great. I'm delighted to engage with you and have a conversation, especially knowing that you and your whole firm is real estate focused. That's great. So the topic demystifying the low income, not low income housing, but affordable housing. Um, One of the first questions I would ask you is the term low income housing versus affordable housing. Can you distinguish, or are they the same, or how do they, or is there a distinguishable difference?
Sure. And this is, I think, an important topic just because I think in, what my background is in the more traditional commercial real estate sector. And
Mhm.
as more and more private capital is getting into affordable housing, although, it's been there for a long time, knowing what affordable actually means is quite important for what you're investing in and for what kind of populations you're serving as well. So the sort of capital A affordable mostly refers to housing that is subject to some sort of regulation. It says that you have to keep it at specific affordability levels through a regulatory agreement or other regime that is imposed on some legal regime that makes it so you can't rent to anyone who exceeds those income levels. Basically, HUD set a standard that said in order for housing to be considered affordable in the sense to something that a human who has a job can afford, that they cannot spend more than 30% of their income stream on housing and utilities. And so what they did to do that is say, okay, if you have a population that is now spending vastly more than that 30%, that housing is no longer affordable to them. And so in order to fund and figure out what kind of affordability levels there are, HUD basically sets census tract based standards that are covered by what's called area median income. So they take the income levels based on census tract of whoever lives in that particular area, and they set, what is the area median income of that population. And then whatever that is, affordability is set based on tiers of those AMI levels. So what's considered low income housing is traditionally 80% of AMI or below. The low income housing tax credit, for example, primarily funds the 60 to 80% below and below. Usually you can blend those two together, and you end up with around an average of 60% of AMI and below. That's considered low income. And then anything above 80%, up to about 130% AMI, kind of fits within the workforce housing strategy, middle income, and can range in a lot of different ways. So you can have subsidized housing that subsidizes any housing within that spectrum, from very low income housing to all the way through workforce housing or middle income housing. And you can have naturally occurring affordable housing, where just because of the nature of the market, the value of the land, the location, even without a rent restriction or without restrictions through some sort of regulatory regime, you're ending up with affordable rates of rental streams just because those are available and affordable to people at those lower income streams, at those percentages of AMI. So affordable housing kind of encompasses all of those things. The capital A affordable typically refers to those that are actually regulated, and then the sort of lowercase affordable includes naturally occurring and sort of unregulated affordable housing as well, that's still available to and affordable to, people with incomes that are below those AMI levels.
Got it. And specifically, you deal in the, not the tax credit, the low income housing tax credit projects, but you deal in more of a market capital. Is that, am I understanding that correctly?
Yeah. So, I mean, I work with a very wide range of multifamily investors, developers, sponsors, syndicators and the like. Traditionally, I have not spent as much time in the low income housing tax credit world, although many of my deals actually do interface or involve the low income housing tax credit. But I think more and more now, there are a lot of opportunities on the LIHTC side, and obviously the more recent federal legislation has expanded access to some of that. But it's only one sector of affordable housing, and there's a lot of interest and focus now on all the rest of the affordable housing spectrum as well. And also what happens to that existing LIHTC and low income housing tax credit, people usually refer to it as LIHTC. What happens to it after it's no longer required to be affordable, like out after it's affordability period, and what happens to those residents, what happens to the housing. So there's a sort of big set of gaps in the market and interest in investing in affordable housing sort of at those various levels now.
Got it. So can you give kind of a description of like a recent deal or kind of a sweet spot of what you typically do?
Sure. I represent all different types of parties. One of my largest clients is a ground lease financier. So similar to a Safehold, they're called the Ground Lease REIT, and they're sponsored by Montgomery Partners, and Montgomery Street Partners, I'm sorry. And we did a deal recently with them where they were doing a sale lease back. So that's how they do primarily all of their transactions. So they acquire the land, and then they lease it back to the same party who they're acquiring it from. The purchase price is then used towards either construction and development costs or for rehab or recapping of existing asset dollars. And then in this instance, it was new construction. So it was the construction of multifamily affordable housing. It also involved a CDBG block grant, and some real estate tax abatements as well from the local jurisdiction. And we combined all of those sources, plus there was a leasehold mortgage loan, all filling out the capital stack. And so what my job was as the lawyer was, how do we fit all these pieces together, right? How do I protect my clients' interests and their ability to ensure that the housing's going to get built, that the value of the asset is going to be there in the long term, and also ensure that the capital stack is fully met, that we have the levers we need to pull if the tenant is not able to finish the project, and how we're going to work with those lenders and with the block grant party, in this case, the county, in order to finance that project.
Got it. So is that kind of a typical capital stack where the grants and tax abatement are kind of a key element to making these happen?
Yeah, I mean, affordable housing is all about public-private partnerships. So you always need to have some kind of public dollars, or not always, but a lot of the time you have public dollars. That's what really makes it affordable. I'd say real estate tax abatements are some of the most efficient and lucrative means of developing and investing in affordable housing, and also for preservation of affordable housing, just because they're very easy to navigate most of the time, even though every single county in the country has their own version of what they give and what benefit it has. But if you can get through it, that real estate tax abatement is incredibly powerful to fill out a capital stack, to balance out what the returns are going to ultimately be. And also there with grants and others, there's, direct grants like the CDBG block grant where you get direct cash towards construction. There's different counties and municipalities will offer land for $1 or for a very small purchase price. So you're offsetting those costs in some instances in exchange for affordable housing. So there's a wide range of how those public-private partnerships work, but the vast majority of affordable housing is funded through some kind of public-private partnership, even in deals where it's all privately financed in terms of the cash going into the deal. Most of the time, unless it's in an area where land costs are close to nothing, you still need some kind of concession to make it work, to ensure that affordability and the investors are still making a return that can sustain the project over the long term.
Got it. And as far as those opportunities, are they identified, or are they recognizable to anybody that's in this space, or is it something that as a project comes together that they're sought? I mean, do you have any sense of that?
Well, I mean, I think affordable housing, just like any sort of commercial real estate endeavor, is very locally specific, right? It relies very heavily on local expertise. And I think more so than many other areas of real estate, because you're talking about residents and people who live there and people with pride of their homes. And so having a local partner who really understands like what the available programs are in that jurisdiction is a big part of unlocking the value, as well as the fact that if you're talking about open market opportunities, particularly for preservation, where there's existing housing stock that's desperately in need of rehab or reinvestment. Finding sellers in that world, they don't typically go to CBRE, right? They're not always on the open market. They're looking for people with like minds. They're looking for a good deal, but less hassle. And so those are a lot, family owner operators, sellers. So you need people who have a lot of expertise and a relationship building capacity at that local level, I think, to find that. That said, there's a lot of huge investors in affordable housing, and all of them have some kind of experience with, government agencies, whether that is they know how to get through a Fannie Freddie loan, whether they know someone at HUD, whether they know the county level executives who provide the particular tax abatements, or the governor of that particular state that's offering specialty grants. The best partners and the ones who really have a lot of success understand that metric and understand kind of that they're going to have to live with some kind of relationship there. And that's going to be a push and pull that they have to get comfortable with.
Right. So you mentioned new construction, and then you also referenced some kind of rehab or existing stock. Um, does the capital stack, does it look different between the two? I mean, are basically talking about the same pools of capital?
I mean, it very much depends on the affordability levels. So, for example, taking the low income housing tax credit, that is primarily used for new construction. It does allow for substantial rehab, but based on the way that the tax credit's priced, it's much more valuable for new construction projects. So you end up with, specialized developers who go through what's a very competitive process to obtain LIHTC credits to do new development. And that usually includes, it always includes the sort of lower income basis. You can have mixed income. So you often have like an 80-20 where you have 80% at market rate, you have 20% at the low income rate, or you have 80% at sort of a mixed income above the LIHTC standards. And the capital stack for that new development will often include, if you're doing that very low income housing, LIHTC credits along with various other sources, from grants, tax exempt bonds, to low interest debt coming from government agencies or GSEs. And that capital stack usually tends to be a little bit less equity when you're doing that low income side. On the sort of more workforce housing side, those capital stacks look like any other commercial real estate deal a lot of the time. They might have lower cost debt. They will have a tax abatement often, but they're usually some amount of LP capital coming in. That LP capital is going to be investing, with a GP. Sometimes there'll be a co-GP or, an additional property manager coming in. There might be different layers of capital coming in through private sources or combinations of philanthropic and private sources as well. And on the preservation side, I'd say there tends to be more on that private capital side. LIHTC, you don't invest in existing assets unless it's like a really substantial rehab, like you're gutting the building in its entirety and building up new units. It's just not worth the wait in those instances. So on the preservation side, again, it tends to be more private capital in that space, along with Fannie Freddie debt, HUD debt, some different kind of GSE or specialized debt piece, along with a real estate tax abatement as well. I will say, though, that more and more now, I've had several different groups come to me and say, hey, I want to do low income housing, 80% or below, and I don't want to use any LIHTC because it's a very long competitive process. If you're not the biggest developer in the country, you're going to be waiting for many, many years. And that time and the amount of legal dollars and expertise and process and working with the right syndicator and getting through all of that process actually increases your costs of construction by a lot. So I've actually seen a lot of newer developers, not new developers, but a lot of developers kind of very interested in the affordable housing space, wanting to invest in their communities, wanting to build and self-restrict the rents at their properties, and do it all through, well, equity capital that they raise from friends and family, from LPs, from other groups. and saying, you know what, I'm going to self-restrict. I'm going to put in a deed restriction on the property in exchange for keeping this at that affordability rate because it's important to me. And in the long run, they actually build the housing for sometimes a third of the cost that you would if you were to wait for LIHTC. You can't necessarily scale the way you do with LIHTC and their smaller projects, but it's a very interesting market right now.
Yeah, a third of the cost. So that's an interesting dynamic right there. I mean, just based on all the layers of costs that are built into LIHTC. Um, Curious, I know like with LIHTC, there's certain time commitments, that the project will stay in low income housing inventory. Are there similar requirements with the other, with more of the traditional capital stacks and with the tax abatement and some of the grants?
Yeah, every single deal is totally dependent on the sort of combination of public-private dollars and abatements and benefits and grants that you put in place. So I'm based in New York. New York City is well known for, and I'm on the board of Women in Housing and Finance, our New York chapter, which is a women's-based affordable housing industry group. And everyone in the group, all 170 members, are focused on affordable housing in various different sectors in New York City. New York City has an extremely robust set of local programs, from real estate tax abatements to combinations of real estate tax abatements and low cost debt, provided by the Housing Preservation and Development Agency and other agencies within the city and state. It has its own state tax credits along with low-income housing tax credits, and all of them set their own standards for you have to keep it at this affordability level for 30 years, 40 years, 20 years, whatever the particular program is. And when you're working with one of those agencies, you're often combining a lot of these different sources and having to figure out, okay, some of these have to be permanently affordable. Some of them have to be only affordable for a period of time. And that goes into your underwriting and what the regulatory regime is. On the LIHTC side, LIHTC at the federal level, so it's a federal income tax benefit. Basically, the tax credit is a credit to your federal income taxes paid by the ultimate taxpayer in the investment. So usually that's a syndicator or a bank who's investing the dollars up front and then going to get the return through the income tax limit that they're going to have later on, the credit that they get throughout the period of the affordability. So that's usually 15 years. That's what the compliance period is. But then every state will say, okay, if you're using LIHTC and you want this other benefit, like a real estate tax abatement, you actually have to extend that. And so they'll put a regulatory agreement in place. It says, okay, well, instead of just the 15 years, you also have to do it for another 15 after that for 30 years. But in exchange, we're giving you a sales tax exemption, a real estate tax exemption, and no mortgage recording tax, for example. So every state, every county has their own set of restrictions. And it's interesting because I think some, more traditional commercial real estate investors will think, hey, it doesn't really matter what the length of that is. I can figure it out in this way, or the longer term, caps my upside. Why would I want to invest in a deal that's required to be the most deeply affordable for 40 plus years, right? And oftentimes when you see the flip side of it, though, you have an issue. For example, in Florida, the Live Local, and there's a Live Local program that's focused on the missing middle. That's that workforce housing sector. It's a real estate tax abatement, and it's sort of issued at the county level. And the way it works is you get a 3-year tax abatement for a new construction project or for a rehab project. What's difficult about that is construction takes 3 years, right? So if you're getting a real estate tax abatement, you have to keep every 3 years re-upping and ensuring that you're going to get that tax abatement again. And it has some, income reporting, and, it's a relatively new program. So seeing what happens after that couple 3 years, is only starting to happen a bit. But without that consistency, you kind of have to underwrite, what happens if that tax abatement goes away? How do we fill that gap in the budget? How do we pay for those taxes? And you can't pass them along to the residents because you're restricting rents. So that's an important understanding that, when you're doing the underwriting and you're thinking about that regulatory regime, understanding the real scope of what's being asked and what that affordability means in the long term for the investment and how long your investment's going to be as well.
Yeah, no, I would think that if you're, a 3-year window is not much, and when you're talking about developing new real estate, that would be kind of dicey because, as we've seen recently, all it takes is a new administration or somebody with a new, you know, a new view on what is to change it, and that could really upset the apple cart in a hurry. Let me ask you just on a an investor as far as their underwriting and sense of return. A traditional non-affordable, you've got your certain expense ratios and expectations with a rate of return. Do you know, in your experience, have the investors found that there's an equal or better opportunity in the affordable housing arena, or is it more of a passion project? Like you said, some people are really committed to the cause.
Well, I think it's a bit of both. I mean, I think there's a lot of interest in from private capital in affordable housing, not just because they feel like it's a good thing, but because it's a stable, powerful investment that delivers high occupancy all of the time, right? The need and demand for affordable housing isn't going anywhere. We've been in sort of an affordability crisis for the last 20, 30 years. And no matter how much stock we build, that still is an issue because, wages aren't rising at the same level that costs are. So in terms of, reliable collections and, resiliency of the investment, affordable housing is a great investment. Is it an easy flip and you get 20% IRR after 3 years? No. And I don't think it's, responsible for an investor to be thinking about affordable housing in that way. They have to be long-term investors. They want to be looking at resiliency. They want to be looking at, how are you filling the gaps? How are you setting operating reserves? How are you ensuring that the resources are available to keep the stock at that value throughout that time where you don't have the levers to pull to increase rents at the same levels? And sometimes also that means thinking about, the neighborhood. Can the incomes in that neighborhood actually sustain, and are you going to find the right tenants for those particular units? So I honestly think affordable housing is almost a little bit more complex than some other commercial real estate because, the neighborhood is so relevant and you have these microcosm neighborhoods, particularly in New York, for example, where certain AMI levels 2 blocks away are not going to garner the same level of interest, or you're not going to have the same kind of tenants that you do, 5 blocks over at different affordability levels, and the community very much matters. So I do think that in terms of investors getting returns, there's great returns in affordable housing, but you have to be realistic about what that means, right? You're not looking at, high teens to 20 IRRs in short periods of time. You can get to, mid-teens or, 8% to 15, 16% IRRs, particularly if you're investing in more structured vehicles. If you're investing with the GP, maybe you're investing directly with the GP or providing guarantee support as a co-GP. There's a lot of different ways that you can make that work. And I also think you have to think about it in terms of the way that affordable housing is structured from a capital standpoint. There's less equity generally in those deals. They are less costly because of that public-private partnership, because of the lower cost debt available, all of those things, right? In one sense, that's great because you're taking less risk. But when you're talking to a lot of investors, their sort of mindset is it's the same amount of work I have to do to put out $5 million as it is to put out $150 million. So why don't I put out the 150 and get more out of it? But I think more and more, especially since 2024 and sort of a lot of the way the market's been, people have been burned by, bad operations, by, over investing in office, kind of assuming a lot of things and then seeing all of this sudden risk and realizing that these short-term real estate investments have a lot more risk than they anticipated. And so I think there's a shift more towards longer term investment, safer investment, and affordable housing is a great vehicle for that. right? You're investing in a community in the long term, you can stay in for a long term. There's a lot more open-ended funds in it. So I do think there's a lot of opportunity there when you look at it, you know, carefully and you look at it in the right approach.
Got it. Um, Tell me a little bit. I mean, you mentioned some dollar amounts, 50, 150 million for a raise kind of thing. What's a sweet spot as far as a size of an opportunity that and a project size that you see?
I mean, I think in the affordable world, it ranges. And granted, as a commercial real estate attorney, I'm not the one putting the deal together. I'm helping close the transaction. So it's
Right.
only sort of what I'm seeing out there. But, there are new construction deals. I think when you have really big developers, large swaths of land, major scale opportunity can be, upwards of 200, 300, 500 units, especially in various parts of New York City and other places where you have the scale possible. But on average across the country, I'd say like 150 units is probably the sort of cap of what you're going to get in a lot of these communities. And more, as I was mentioning, there are a lot of people looking at doing smaller chunk deals, right? 20, 30, 50 unit buildings. Those projects are going to be 20, $30 million, maybe, depending on the location. And that means the capital needs that they have on the equity side are very small. They're like 3, 5, $10 million at most. And so there are a lot of groups there, putting together capital, and they're having a hard time. And it's a lot of work to find the investor who's going to say, okay, I'm going to stick with you. I see you have 6, 7 deals in the pipeline. Sure, all of them are $3 to $5 million investments, but in the aggregate, I can put $20 million to work, 25 million. I know I have a pipeline. We're going to get them online really quickly. So I do think that those check sizes range a bit, but on average in the affordable world, the equity check sizes are smaller because the equity needs tend to be smaller given you're leveraging so much with public dollars or with public subsidy.
Got it. And just as far as a percentage of the capital stack, do you have any kind of a sense for uh, what the equity looks like as opposed to the grant or tax abatement portion versus the debt?
I'm gonna back out of this question just because
Okay.
I can't pretend to be the expert in that. I
Okay.
kind of just see what comes across my desk. And what I spend most of my time on is helping my clients identify risk and
Right.
structure around it, right? Is trying to figure out like how do we get this deal to work? How do you get the rights you need? How does the governance, reduce the risk that you're gonna have when you're investing in that deal? And you're taking that risk on that particular sponsor or, you know, asset.
Got it. Got it. Well, that's a great segue to the portion of the show that I like to refer to as the biggest risk. Um, by day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. That's not an option. We look to see if there's a way we can minimize the risk. And if we are not able to avoid nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, could be the interest rates, could be the tax credits, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Danielle Ash, what is the biggest risk?
Well, I'm going to give a self-serving answer and then I'm going to give more of an investor-based type answer. So the self-serving answer, I think, is, people come to me from all different sectors of real estate and at all different parts of their career, from early stage developers, sponsors to, super high net worth sovereign wealth funds who've been investing for 50 plus years. And I do think one of the biggest mistakes or risks that people face is not having good counsel involved in their transactions. Having transactional counsel who has the combination of wanting to explain the risk to you and able to do it in a way that you understand. And also not getting in the way of the transaction just to look smart or kind of win the point. There's a balance of trying to identify risk and be creative about how do we structure around that risk? How do we get you, the protections you need? How do we think about all the different ways that bad things could happen and you need to address? And how do you help your investors and protect your investors in the long run through those? But at the same time, what good is it if you can't close the deal, right? And knowing the difference between what risk is worth cutting the deal over and what risk is something that you can find a mitigation for. So that's on the self-serving side, because, all the time I see attorneys who aren't really doing that extra work, or where clients come to me and they've done a deal and they didn't see this issue before, and now they're facing it and they need real explanation as to why we have to think about it. On the investor side, I will say that, just thinking about policy for a second, there's been a lot of change in policy at the federal level, at state levels, everywhere right now. It's a bit of a crazy time for trying to follow what's happening. And while there has been a lot of great gains for, the low-income housing tax credit for changes in that policy, I do think that, and I'm borrowing this from one of my clients, Sharif Mitchell at Northern Liberties, that the risk of a lot of those policies is actually on the populations being served by affordable housing. And we don't always think about those sort of tertiary elements. We don't always think about the fact that, they still have to put food on the table, that they have to figure out how they're going to get, their children to school, that they have to commute. All those costs come into play. And what we've seen over the last few years with a lot of affordable housing, especially coming out of COVID, is you have a lot of high arrears issues coming up, because tenants have to choose. Do I pay my rent or do I feed my kids? And when you have policies that make those potential decisions harder, or where they're losing potential benefits, in some states, it's very hard to get your tenants out for non-payment. And so a lot of them are going to take the risk that, maybe I'm just going to feed my kids instead. And so I do think that's something important to think about, that when you're putting together a capital stack, you're looking at the population, you're figuring out how you're going to serve that population, how you're going to work with those people to ensure that they have the capacity, they have the other resources they need to stay in that housing, because that really is going to impact the value of your asset in the long term as well.
Yeah, it's interesting, all of the the components and how dynamic the picture is when you do start to do a deep dive into it and recognize all of the elements of risk there. That's great. Hey, Danielle, where can the listeners go if they'd like to learn more or connect with you?
So I'm extremely active on LinkedIn. Danielle Ash you can find me on LinkedIn, or our website is adstack, ADSTACH.com. I'm listed there. My email and my phone number are there, so you can always reach out via email, as well as my LinkedIn. So connect with me anytime.
Awesome. Well, Danielle Ash, I cannot say thanks enough for taking the time to talk. I've thoroughly enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, I look forward to it. Thank you so much for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.